We talk about, what central banks can do, what governments can do to support the currency, but it's not really that. It's really about when the Fed pivots and signals that perhaps its rate rises are ready to ease.
Exactly. This could last for a little bit. Incredibly strong U.S. economy, an aggressive Fed. We do feel the U.S. dollar is ultimately quite expensive, so I think over time it will normalize. But as long as this imbalance exists, I think it could keep strengthening. So a real problem for investors and corporates alike.
What is over time? How much longer, how much higher can the dollar go?
I think this could easily move into 23 before we see sort of a stabilization of currencies.
So when you take a look at the Chinese yuan inching ever closer to that psychological level of 7, do you see that impacting how companies look at the growth potential, how China looks at its growth potential?
It's interesting you ask that, because while there's so much volatility in FX, in rates, in commodities, actually what we do see is companies doing more and more global business. I think that's the real positive news about today. The globalization keeps going in the corporate world. We may see some conflicts on the political side, but corporates, through social media, through e-commerce, are doing business increasingly global, and that's what we're spending a lot of time on. And currency moves are obviously something they need to manage, but it's not something that changes their long-term strategy.
What is the long-term strategy? What are you hearing from your clients?
Yeah, exactly what I said. I think they want to be global. If I see when we're helping Chinese companies in Latin America, European companies coming to China, this idea that we're going to deglobalize, you don't see it at the corporate level. They need to, be close to the customer, produce in the countries where they are selling the product. So we see a lot of that. So that's what we're working on with clients every day. In the short term, there are some acute issues, and that is managing risks around FX rates and commodities, and also looking at the funding, because this whole volatility has put a lot of pressure in some segments of the corporate world on the funding requirements.
Well, Sjoerd, this is exactly what I wanted to get to. This is Rish in Hong Kong, by the way. You got margin compression. The era of free money is at an end now. How do you actually make yourselves more efficient, make yourselves more dynamic in order to mitigate those shrinking margins?
Yeah, you're right. Exactly at a time when margins are going to get under pressure, it's actually more difficult to be efficient. Particularly on the working capital front, corporates are facing numerous pressures. Just in time has moved to just in case, so they're holding on more inventory. You have more risk embedded in that, price risk, and your funding cost has just gone up dramatically, with short-term rates peaking probably at 3.5 from pretty much 0. So, and then you also have suppliers that you no longer have the leverage over that you used to have, because you need them in this day and age. You want them to prefer you over others. You need to ensure certainty of supply. So all that together makes managing working capital very, very difficult, but we're working with clients to try and optimize it.
So, Sjoerd, let's just quickly have a look at, these capital markets, because of the end of free money, they're also becoming less friendly, let's put it that way. How do you then ensure that you have, revolving lines of credit which are not going to get blocked, I suppose?
Yeah, we see a lot of clients indeed putting on more liquidity, and because of the capital markets being somewhat volatile, they try to do it in loan markets. So you see a lot of increases in RCFs, you see a lot of short-term liquidity facilities, particularly in sectors that are very exposed to commodities and margin calls related to commodities. And you also see clients trying to tap the term loan market, which is still reasonably accessible and better priced than the capital markets. The capital markets are obviously repriced dramatically, both for treasuries but also spreads. And you've seen the effect of it. High yield issuance is down 80%, emerging markets are down 50%. And high-grade markets are open, but it's costing a lot more. I will say on the cost of it, though, we have to get out of this thinking that the last 10 years was the norm. So in a sense, 3% long-term rates, we may look back in 2 years' time and say that was quite attractive.
Where do you see rates headed in the next 12, 24 months?
We think they're reasonably priced at this stage, given the Fed action and the economic outlook, but we do actually think as a firm that we're going to go into a 10-year period or longer of higher inflation. And if you add to that real interest rates of 2.5%, we actually don't think it would be unthinkable to have sort of 10-year rates at 5.5%. That won't be for this year, won't be for next year, but you could see a trend there if inflation indeed stabilizes at a higher level than we historically have seen it.
Amidst all the debate about whether a recession is coming or not, what's your own take on it? Can the Fed engineer a soft landing?
We're hopeful because, both consumers and businesses are in great shape in the U.S., so that's an important one. Europe, I think the governments are going to spend a lot of money to, make up for all the cost of energy, so that may offset some of the pain that's going on there. So I think we have a good chance that both economic blocks, sort of skimp into recession, but not the sort of aggressive scenarios that we've seen in previous sell-offs.
Are we perhaps underestimating the weakness in China that could impact the rest of the region and the rest of the world?
Interesting. I think China has fueled the growth of the world for many years. We used to see 8% type growth in China, and that benefited all of us around the world. We won't see that in the future. Obviously, it's difficult now, and it may bounce back next year to 4 or 5%. But over time, China will grow 5%, 4%, 3%, that sort of zip code. So, I think that we will have to live with the idea that global growth will not be fueled as much by China as it was in the last decade.